Chapter 3, Part 1, Items on the Balance Sheet. Now, there are 3 parts for this chapter. This is just the first one. And what we're going to do first is talk about what items are on the balance sheet and where they go, or an idea of where they go, because I think that in some ways, particularly in categories, is a little subjective. All right. So, the diagram below shows the relationship among assets, liabilities, and shareholders' equity. That's our infamous formula in accounting. And the subclasses are assets we need to break down between current and non-current or long-term. Liabilities also we need to break down between current and long-term or non-current. And stockholders' equity minimum has paid-in capital, common stock, and retained earnings. Now what we're going to do is we're going to go through a bunch of balance sheet account descriptions, and we're going to look at where they go based on explaining the elements in each section. So we're going to start always with the GAAP. We start with our current assets. Now, current assets are those assets expected to be converted to cash or consumed within the coming year or within the normal operating cycle of the business if that's longer than 1 year. An example would be if you were a large shipbuilding company or you built planes, which may take 2 years, then 2 years might be your operating cycle. So that would be current assets. Everybody else, if it's less than a year, it's always going to be 1 year. Now, what are those categories? First, we have cash and cash equivalents. This category would include cash and any securities that are held for 3 months or less. So, these would be ones where you have some extra cash and you just want to park it for a couple days in some mutual fund or whatever. Or you have some savings bonds or stuff like that. Then we have short-term investments. The company has the ability and the intent to sell within the next 12 months or the operating cycle, again, whichever is longer. Accounts receivable. These result from the sale of goods or services on account. Notes receivable, supported by a formal agreement or note that specifies payment terms that are within the next 12 months. Otherwise, it would be non-current. So you can have both current and non-current notes receivable. Prepaid expenses. These arise when a company incurs a cost of acquiring an asset in one period that won't be expensed until a future period of 12 months or less. Now it arises from a company incurs a cost of acquiring an asset. If greater than 12 months, again, this would be non-current. So those are some of the categories under current assets. So now what we're going to do is we're going to look at this example, and we're going to first look at what falls within that classification of current assets. And we're going to start with our list on the left and then work our way to the right. So the first thing we're going to notice is accounts receivable. Accounts receivable are never going to be beyond 1 year. Otherwise, they would be a notes receivable because you wouldn't let people owe you that much money for that long of a period. Allowance for uncollectible accounts is a contra account to accounts receivable, and normally these are shown net on the balance sheet, and then they'll show a note in the description that tells them how much is in the allowance account. Then we have prepaid expenses. Again, with prepaid expenses, it would depend, are they prepaid expenses for a year or less? If they are prepaid expenses for beyond a year, then that portion would be treated as long-term. Cash is always current. Interest receivable, it's due in 3 months, so that meets our criteria for short-term. Inventory, again, if we're churning our inventory, and usually you don't want that sitting on the shelves too long, that would be current. And our short-term investments. So now let's look at the balance sheet presentation based on liquidity. Now, this is how they, i.e. the book, shows you cash, short-term investments, accounts receivable, less allowance for doubtfuls, interest receivable, inventory, and prepaid expense. Just so you know, I would normally have put inventory before interest receivable, but again, you'd want to look at the detail to see exactly when that interest is going to be received. Now again, these two accounts are normally netted on the financial statements, and then they have a description along with net accounts receivable that tells you the amount for allowance. Now we're going to look at our next category, which is long-term assets. Again, these are anything that we expect to convert to cash or consume for more than 1 year or the operating cycle. Investment, we're going to start with the first category, which is investments. Now, here's the big difference. Assets that are not used directly in the operation of the business. So, if somebody buys something that's outside their normal scope of business, i.e. they buy a piece of equipment that they believe is going to go up in value, but they're not going to use it, that would be considered an investment. And anything that happens when you go to sell it is going to be treated as part of other gain or losses. So, we would have our restricted cash to be used in 10 years, our notes receivable due in 2 years, and our long-term investment. Now we can look at how this is going to show up on the balance sheet. All right, now, this is the way they showed it, but I would not have showed it this way. I would have shown, I would have shown the notes receivable before the restricted cash, since they're not going to use it for 10 years. But this is just how they showed it in the answers. So I think there's some subjectivity unless they tell you due dates. But not only that, the notes receivable is due in 2 years. Shouldn't that be before that restricted cash? I don't know. My opinion, throwing it in there. All right, now we're going to look at PP&E. Now, these are tangible, i.e. you can see and touch them, long-lived assets that are actually used in the operation of the business. Now, remember, these have a useful life of greater than 1 year, which means we're going to have to depreciate them as we receive service from them, except, of course, land. So, we're going to now go through and pick those out. We've got our accumulated depreciation for the building and equipment. We've got our building. We've got our equipment. And we've got the land because it says it's in use. If it had said not in use, it would be part of the investment category. Now we're going to look at how that would appear on the balance sheet. Here we go. We've got our subcategory, our category property, plant, and equipment. We'd list them all, and then the accumulated depreciation. Just so you know, on a lot of financial statements, they show building and equipment net of accumulated depreciation. And in the footnotes, they'll tell you how much there is. And in this case, I don't know, I would have put the equipment first, then the building, then the land. That's just my opinion, but this is how they showed in the answer, so that's why I'm showing it to you. All right, now we have intangible assets. They cannot see or touch, but they are actually used in the business, so we have to amortize them. And they're always shown net of amortization. So these you can't see or touch, and the first we would have is patent, and then we have a copyright. Now, when these are amortized, the amortization is taken directly against the asset account, unlike accumulated depreciation, which is shown separately from the equipment or the buildings itself. So, this is how it's going to look on the financial statements. And now we have completed the asset section. Now we're going to go to the other side, which is liabilities and equity. So, current liabilities, expected to be satisfied within 1 year or the operating cycle, whichever is longer. So, we go through our list. We know accounts payable would be. Those are amounts we owe our vendors. We have a notes payable due in 6 months. We have interest payable, we have income tax payable and salary payable. Now let's take a look at what this looks like on the balance sheet. Now, personally, I think I would have had salaries payable after accounts payable, because normally you can't wait too long to pay. Usually you're going to pay them the next week. So it's just my opinion. So this is what this would look like. Now we're going to do our long-term or non-current. So long-term liabilities are obligations that are due to be settled or have a contractual right by the borrowing company to be settled in more than 1 year after the balance sheet date. So we'll take a look at this. We've got a bonds payable, and that's all we have. So that's what that looks like, and then we have our total liabilities. Now we're going to go to our equity section. Stockholders' equity. Assets minus liabilities equals stockholders' equity. Here we've got paid-in capital, which would be common stock and additional paid-in capital, and we have retained earnings. This is sometimes referred as net assets or net book value. It also includes an area that we haven't covered yet, which is accumulated other comprehensive income. Now we can look at our example. We would take the additional paid-in capital, our common stock, and our retained earnings. Now we can finish up our balance sheet. And here we are. That's what your balance sheet. Now I want you to know it can actually be a lot longer than that. And in this case, I did it side by side because otherwise it'd be too long to put on white paper. But most cases, they list the whole thing. So this gives you an idea to help you with your homework when you're having to categorize those. Now, the last thing we're going to cover is the international standard balance sheet. Differences in balance sheet presentation according to the U.S. GAAP and those prepared applying to the international standard. International standards specify a minimum list of items to be presented in the balance sheet, which means that you might show an account that you don't even have any activity on. U.S. GAAP has no minimum requirements. International standard, they changed what they call the balance to the statement of financial position. Some companies use it as well. You'll notice that they use a lot of different names for the balance sheet. And balance sheets prepared using the international standard often report non-current items first. Yeah, it's kind of upside down from us. And the terminology is a little different. So, if you get a chance, you might want to look at a financial statement prepared under IGAAP so you can kind of get an idea of the difference. And that includes this presentation. And you have 2 more to go. Thank you.